Hello everyone and welcome to Fire and Finance. Today I want to go over the 4 stocks that I've been buying recently and plan to keep buying. Here is my dividend growth portfolio that I have in M1 Finance. The purpose of this portfolio is to invest in dividend paying stocks with a history of increasing their dividend payouts over time. Essentially, I am creating my very own dividend ETF in which I receive monthly dividends without paying an expense ratio. Let's take a look at my recent buys. So I go here to activity, look at today, and I bought 4 stocks for a total of $326. The first stock that I bought in is Omega Healthcare Investors, ticker OHI. I invested $100 at a share price of $31.48, giving me 3.17 shares. Next, I also invested $100 into HP, ticker HPQ, at a share price of $27.20 for 3.67 shares. I also invested $100 into Broadcom, ticker AVGO, for a share price of $501, giving me 0.19921 shares. And then finally, I brought AMGEN, ticker AMGN. I invested $26 at a share price of $219.25 for 0.11936 shares. Let's take a look at these stocks one by one. First, we'll start with HP. So HP is currently trading for around $27, giving it a PE of 7.41. and it has a dividend yield of 2.8. Let's take a look at the financials. We'll start with the income statement here. So when I'm looking at a stock, first I want to look at the top line revenue. Ideally, I want a company to have revenues that are growing. So let's look. In October 2016, HP had revenues of $48.2 billion. We look here over this graph on Seeking Alpha. It will show us that it's using billions for the units here. That's pretty standard. So we have 48.2 billion, 52 billion, 58.4 billion, 58.7 billion, 56.6 billion. And the trailing 12 months is 62 billion. So we've gone from 48.2 billion to 56.6 billion. We have increasing revenue. This is good. This is what I want to see. So let's keep going down the income statement. And next I want to look at the net income. So here we have the net income. Much like revenues, I want to see it going up over time. So we have net revenues of 2.4 billion, 2.5 billion, 5.3 billion, 3.1 billion, 2.8 billion, and the trailing 12 months is 4 billion. So we've gone from 2.4 to 2.8. I'm not really sure what's gone on here where it jumped up to 5.3 billion and then it's been going down since. But I looked at the 5-year trend, and the 5-year trend is it has gone up. Not much. It's a very stable, boring company in that way. But net income is growing. That's good. Next, I want to look at the balance sheet. Okay, so the first thing I want to look at on the balance sheet is the current ratio. The current ratio is the total current assets over the total current liabilities. So let's look at current assets. Go down to total current assets. And in the last year, 2020, we have 20.6 billion in total current assets. If we go down further into the liabilities, we'll see that for 2020, the total current liabilities are 26.2. So we have 26.2 versus $20.6 billion. So unfortunately, HP has more short-term liabilities than short-term assets. That's a negative. Ideally, we would want to be able to say that the company has short-term assets that it could use to cover its short-term liabilities. One more thing I want to check out on the balance sheet is what's going on with the shares outstanding. So if we look at this line, total common shares outstanding, we can see that they've been decreasing over time. So that went from, let's see, what is this in billions? 1.7 billion in October 2016 down to 1.3 billion in October 2020, and the last reported is 1.1 billion. So they've done a tremendous amount of buybacks over the last 5 to 6 years to reduce their number of shares from 1.7 billion to 1.1 billion. This is nice because it means that the shares I own in the company represent a larger stake in the company over time without me having to buy more shares. So that's all I want to look at in the balance sheet. So next, let's look at the cash flow statement. The main thing I want to look at in the cash flow statement is just the free cash flow, the unlevered free cash flow, which should also be in billions. So it had 13.2 billion in October 2016, and then it did 3.2, 3.9, 4.1, and 3.4 billion. So looking at this, the first thing I think is that something must have happened in 2016 to reduce the amount of cash flow that the company would be making. Unless 2016 was a fluky year, but I don't really have that data. I don't pay for it to see. I know that around 2016 was when HP split into two companies. So it's possible that this number and its next year decline and then remaining stable at around 3 to 4 billion is a result of HP splitting into two separate entities. I'm not going to look into that right now to verify. I want to go to my stock evaluation tool. So this is a tool I use to get a quick and dirty estimation of a company's value. So I have the ticker symbol. I can just put in the ticker symbol, and then some of this data updates automatically. So let's look at HP. Company name, HP, pulled from Google Finance. Price, $27.24, pulled from Google Finance. The market cap, $31 billion. This is pulled from Google Finance. And shares outstanding, pulled in from Google Finance. And then I input the dividend yield right here, which we said was 2.8 from Seeking Alpha. The cells highlighted blue are ones that I put in the data myself. So we have the dividend yield of 2.8%. I pulled the 2.8 from Seeking Alpha. Blue cells are ones that I input data myself. I then also put in information for the free cash flow for the last 5 years. So starting with 2016, I put in the 13.3, and then so on and so forth until the last year. So I have 2016 to 2020 data in here. And then based off the free cash flow, I determine possible valuations. So these would be the free cash flow multiples. So if the company was trading at 10 times free cash flow, the average free cash flow of the last 5 years would give it a value of $56 billion. This would be the market cap. So I've done 10, 12, 15, 18, 20, and 25. And I also calculate based off the minimum cash flow in the past 5 years, the average, and the maximum cash flow of the past 5 years. And then that gives me an idea of possible valuations for the company. And then over here, it's the same thing. It's just instead of giving the market cap, it gives stock prices. These are all green. So green means that the current valuation shown here is greater than the valuation currently. If it was red, then that would mean that it would be under. Calculate the free cash flow multiple. So cash flow of the last 5 years averaged out and then divided by the market cap gives a multiple of 6. So HP is extremely undervalued based off its free cash flow. Typically, stocks trade for 15 to 20 times free cash flow. The market is a little bit overvalued right now. So in this bull market, it's hard to find stocks that are trading in that 15 to 20 times free cash flow multiple. But ideally, as a value investor, that's what I'm looking for. I also want to check that the dividend payout is safe. So here we have the dividend paid out by the company. This is calculated by taking the market cap times the dividend yield. And then I look at the last year's cash flow to see if it was covered. And if it is, it's green. If it's not, it's red. I also have these checks over here. So dividend is greater than the S&P 500 yield. Yes. Typically, for my dividend growth portfolio, I want to invest in companies that have a dividend that's higher than the S&P 500 yield or the total stock market. And the reason for that is because if I had a choice between investing in a company that had a dividend yield less than the stock market or the S&P 500, I would probably just invest in the S&P 500 because the purpose of my dividend growth portfolio is to provide me dividend income. So if I can invest in the S&P 500 instead of an individual company, I would, because it's more diversified, there's less risk. So I'm not going to take on more risk for a lower dividend. Next, we have increasing revenue, which I look at Seeking Alpha. I look at the financial statements. And as we looked at for HP, we had increasing revenue, we had increasing net income, we had increasing free cash flow. Now, I know technically from 2016 to 2020, the cash flow has gone down. But 2020 is either a fluke year or it has something to do with HP splitting into two entities. So I am fine just taking out that first year of cash flow and doing my analysis with the past 4 years. So after doing that, we go from 3.2 to 3.4. Just barely, we're increasing cash flow. Looks like HP is a very stable cash flow company. Current ratio, which is the ratio of current assets to current liabilities. Unfortunately, the company had more current liabilities, so this is a no. This is a red flag, but they were close. So this is not enough to prevent me from investing in it. Shares outstanding decreasing. Yes, we saw that in the balance sheet. And then price to free cash flow. This is a little bit subjective, but I'm saying yes here. It's trading at an 8 multiple to free cash flow. Assuming the stocks normally trade between 15 to 20, taking the average cash flow, the company should be valued at $55 billion, and the current market cap is $31 billion. The current share price is $27. Could go up to $48 for that valuation. Of course, they're constantly buying back shares, so the share price could be even higher than $48. So, since HP is undervalued based off the cash flows, I'm investing in it. I think it's incredibly cheap right now in a market that's overheated. So, HP is a stock I'm investing in. Next, we had Broadcom. So here we have Broadcom, ticker AVGO. It's trading at a PE of 18.09 and has a dividend yield of 2.85%. Let's jump into the financial statements. Start with the income statement. Revenues, looks like they're trending up. We go $13.2 billion in October 2016, and it looks like we increase every year: 17.6, 20.8, 22.5, 23.8, and the past trailing 12 months is 26.5 billion. So revenue's increasing. Let's look at that net income. Net income, so it was negative 1.7 billion in 2016, 1.6, 12.2, 2.7, 2.9. All right, so it's increasing. Also, I want to point out that when we go to my stock evaluation tool, I'm only using 2018 to 2020 for data. And the reason for that is that Broadcom was purchased around that time, and so the current Broadcom company was incorporated in 2018. So I don't want to use data before that because I don't think it's fully representative of the full company now. All right, here we are in the balance sheet. I have two main things I want to look at in the balance sheet. Let's look at the total current assets. 11.8 billion as of 2020. And we have total current liabilities of 6.3 in 2020. So that is a check. We have a current ratio greater than 1. The company has current assets that it could use to cover its current liabilities. Now let's look at total common shares outstanding. We've gone from 389.3 up to a last reported of 412. Not sure how I feel about that. It does look like they started decreasing shares from 2017 to 2019, and then because of 2020 they started issuing shares again. Not sure why that is. It's not by a lot, so I'm not really concerned by this. Now we are in the cash flow statement, and all I really care about here is the free cash flow. So it goes from 3.6 to 5.4, 7.8, 12 billion, 12.9, and then the trailing 12 months is $13 billion. So I think in my stock evaluation tool, I threw off the first 3 years here because of the merger, and I'm only taking the free cash flow of the last 2 years in the trailing 12 months because there was a merger in 2018, the company was bought out, and so its financials are going to be different before and after. So let's jump into my stock evaluation tool. So we have AVGO, Broadcom, market cap of $203 billion, current price of $494. I've put in my cash flows, and that's telling me that it's selling at a free cash flow multiple of 16, so it's fairly priced. It's not growing here, so I wouldn't want a higher multiple. The dividend is covered. Dividends higher than the S&P 500, increasing revenue, increasing net income. The free cash flow has increased over the past 5 years. Current ratio is greater than 1. Shares outstanding is the only red mark against it, but it wasn't by very much. I'm not concerned. And so price to free cash flow is a yes. Buying it at fair value, 16 times free cash flow. So I'm buying this stock. Alright, so next we have AMGEN, trading at $215 a share with a PE of 13.38 and a dividend yield of 3.21%. Let's take a look at the financials. We start with the income statement. We look at the revenues. 2016 was 2.8 billion. Then it did 21.7, 22.5, 22.2, 24.2. Revenues are increasing. Let's take a look at that net income. We have 7.7, 1.9, 8.3, 7.8, 7.2. So technically net income is decreasing, but it looks like it's for the most part bound between 7 and 8 billion. Looks like 2017 was an odd year. So let's jump over to the balance sheet. Total current assets in 2020, 21.1 billion. Total current liabilities, 11.6 billion. So current ratio's good. The company has the short-term assets to cover the short-term liabilities. Let's take a look at total common shares outstanding. We've gone from 738 in 2016 to 578 in 2020. So shares have been going down. Last reported is 569. So shares have been going down at a pretty good clip over the past 5 years. Finally, we have the cash flow statement. And if we go down to the bottom to look at the unlevered free cash flow, December 2016, 7.4 billion, 9.2 billion, 8.7 billion, 7.2 billion, 9.6 billion. So free cash flow has been going up, although rather slowly. So let's go to the stock evaluation tool. Here we have AMGEN, market cap of $124 billion, trading at a free cash flow multiple of about 15, right? So you average the cash flows for a multiple of 15, it's $127 billion. It's trading at $124 billion, so it's fairly valued. Cash flow has been increasing over the past 5 years, so potentially if it could be worth $152 to $169 billion. It's fair valued. I'm buying in. There's not a lot of stocks that are trading at good valuations right now. Dividend payout is covered by the cash flows. Going through our check marks, the only one that's red here is the net income, but free cash flow and revenue look fine. It's a bit worrying, but it wasn't too much of a change, so I'm buying in at this one. Gives me a 3.21% dividend. I'm pretty happy with it. And then finally, we have Omega Healthcare Investors, ticker OHI. This is a REIT. Instead of PE, we use P to FFO for REITs. So P to FFO, which stands for Funds from Operation, is 9.6. Dividend yield is a whopping 8.41%. This is a new addition to my portfolio, and it's the highest yielder now at this point. So let's take a look at the financials. Let's look at the income statement, the total revenues, 900.8. I assume this is in millions. Yep, 900.8, 908, 881, 928, 829. Trailing 12 months is 914. So it looks pretty locked in between 880 and 930 for revenues. They're pretty flat. That's okay. Wouldn't really call it increasing, wouldn't really call it decreasing here. Let's look at the net income. 366.4 million, 100.4 million, 281.6 million, 341.1 million, 159.3 million, and again the trailing 12 months is 214.6. So this is a bit all over the place, so that's a bit concerning, but also it's not declining too drastically. And this company mainly owns and operates skilled nursing facilities, and I know that has been a hectic area for the past 2 years. So that kind of shows why 2020 and the trailing 12 months are down. So it's just something to consider. Let's go to the balance sheet. So actually, no, wait, I forgot here. Typically, REIT balance sheets don't have currents. So I go to overview, and then I look at the current ratio here. So a current ratio of 1.8, so that's good. Total current assets are greater than total current liabilities. That's good. So now let's go back to the balance sheet and let's look at the shares, which I can guarantee are going to be going up. Not too bad, actually, but typically REITs issue shares as they acquire new properties. That's just one of the quirks of REITs that makes them different from most other stocks. So it's going to be rare to see one that's decreasing shares. Typically, you're going to see increasing shares. So I don't even consider that as a negative when I'm looking at REITs. It's gone from 196.1 in 2016 to a last reported of 237.6. So somewhat significant increase, but again, expected for REITs, not a concern at all. So let's go over to the stock evaluation tool. Here is the information for OHI. I've put in the dividend yield, 8.41%. That's kind of high for a dividend yield, but that gives a dividend payment of $641 billion. No, $million. $641 million, and it's been covered by the last 3 years of cash flow. The last year covers it. So dividend looks safe on free cash flow, and the company is trading at free cash flow multiple of 11, right? So the average cash flow at a multiple of 12 gives value of the company of $8.3 billion, and currently the market cap is 7.6. So valuation looks good, and it has a great dividend. So I am diving into the stock. I want it to be a much larger holding in my portfolio. Looking over here, dividend to S&P 500, yes. Increase in revenue, yes. Net income, no. Free cash flow, yes. Current ratio, yes. Shares outstanding is a no, but we don't care about that for REITs. In fact, we expect it to be no. Price to free cash flow, yeah, looks good. Dividends covered. This is great. And so I'm buying into Omega Healthcare Investors as well. So for one last time, those are the 4 stocks I've been buying into. Omega Healthcare Investors, ticker OHI. HP, ticker HPQ. Broadcom, ticker AVGO. And AMGEN, ticker AMGN. Tell me what you think about those stocks down below. Like and subscribe. Also, let me know if you would like other deep dives into companies that I'm investing in, and I go through the financials with you. I kind of like doing this, so let me know if you'd like me to make more videos like this. Thanks.